So today I wanted to talk about municipal bonds. They are fixed income instruments whose cash flows are not subject to federal and state taxation in general. They're also called munis. They are loans issued by government to build things like bridges or schools or roads, things of that nature. Um, there are a few different types. One is a general obligation bond, and it's just backed by the full faith and credit of the issuing entity, the state, or whatever that might be. There are two types there. One is limited, where they're going to, raise taxes like property taxes, things of that nature, to pay the coupon payments on here. Limited ones, they're allowed to raise it up to a certain threshold. Unlimited ones would mean they could raise it as much as 100%, but those are typically subject to voter approval. There are also revenue bonds. Now, these typically are backed by revenues of a project. So let's say you have a bridge and you're going to have a toll on it, then the toll that will help pay the revenues for these bonds. Now, some of them are non-recourse. That means that if the project fails or for whatever reason the cash flows aren't what as expected, then you're not going to receive the coupon payment or the interest on these bonds. There's also some conduit borrowers that could be, typically it's going to be a private entity like a not-for-profit, college or university, a not-for-profit hospital, and the municipality is going to be the middleman there and make this a municipal bond. Now, the municipality isn't obligated to make the borrower whole, or I'm sorry, the lender whole. That if for some reason this private entity isn't able to make the payments, then that's just how it happens. Now, typically the coupon payments here are tax free. So depending on your tax rate, think about the equivalent rate you would need to get on a taxable bond in order to get the same rate on a municipal bond. Now, I say they're typically tax-free because if you're in one state and you're investing in a municipal bond for another state, then you would be subject to those state taxes or your state taxes because it's out of the state. And alternative minimum tax rules still apply. So if you're above that threshold, you're still going to pay taxes on these. Also, if you're at some bracket where you're not subject to any taxes on your Social Security and this bond pushes you above that threshold, then you'd pay taxes on your Social Security because of your municipal bond. The same type of thing would happen. There's a few complicated ways it can happen, but if a company, an S company, owns a municipal bond, then there are ways that you could kind of indirectly end up paying more taxes because of it. Now, if you want to see a video out there, check this one out. I talk about thinking about taxes in your investment strategy in general. Check out that video there. You can follow that link. Finally, just wanted to mention that there's nearly $4 trillion US worth of municipal bonds out there. So there's certainly a lot out there. That isn't to say that it's a particularly liquid market. It is actually a fairly illiquid market. So you wouldn't want to invest in mutual bonds if there was a potential that you were going to need that money back quickly. You might end up paying significant trading costs. I hope you enjoyed that. Thank you so much. I'm Brian Kozlowski.